Hi, everyone, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Paul Silva. Paul's a life insurance and a long-term care insurance specialist, and he wanted to share a unique life insurance strategy with us today. Thanks, Paul, for being with us on the show.
Well, it's great to talk with you again, Mark.
So, Paul, tell us first a little bit about your background. How did you get into the life insurance industry, and where are you today with that?
Well, I started out in the insurance industry shortly after I completed college, and I was still kind of in the learning mode. So I went into it with the intent of getting a CLU and CHFC. Basically, I went the academic way, and I've been in the life insurance segment for better than 35 years now.
Okay, so tell us a little bit about this life insurance strategy at a high level. I know it's more of a cash accumulation strategy, so why don't you talk about that?
Okay. I think the first thing that's helpful to understand this concept is to realize that sometimes you can get more out of something if you just look at it differently.
Hmm.
The average consumer and a lot of agents look at life insurance as if it were a commodity, where,
Hmm.
like a 5 pound bag of sugar, you want to pay as low a price for it as you can. And
Hmm.
with term insurance, that makes sense because it is kind of a commodity. You want to get as much coverage as you can for as little out of your pocket as possible.
Hmm.
But if you were to look at it differently, for example, turn it on its head and say, but what I want to do is accumulate cash. I want as much money for me to use in my lifetime as possible. Then I only want to carry the minimum amount of life insurance in order to keep the IRS happy and give me all the benefits we're going to talk about.
Right. And now tell me a little bit about this. I know you had a personal experience where you actually did this for yourself and it actually paid dividends. Why don't you talk about that personal experience first?
I'll forgive the dividend pun, but at any rate, yeah, it did pay dividends. It worked out very well for me because I caught this virus that wiped out my kidney. And no, well, actually, that's the second half of the story I didn't even tell you. After I had a liver transplant, I had to get a kidney transplant, but let's not go there. At any rate, while I'm waiting around for a kidney, I'm sorry, that's more recent. Liver, I had to be disabled. And
Hmm.
while I was disabled, I didn't want to take a loan against my 401k because I knew that if you stay disabled for more than a year, they're going to accelerate it into a fully taxable distribution instead of a loan.
Hmm.
And they're going to whack you with the 10% penalty.
Wow.
So I had
Okay.
access to my money, even though I wasn't 59 and a half yet, and it worked out very well.
Okay. So I see. So you had, unfortunately, an unexpected virus that hit you. You know, you
Yeah,
had to have a disability because of that, and you were able to tap into your life insurance instead of the 401k, which is a
correct.
better tax advantage way to access the funds you needed to cover your life expenses, your living expenses while you were disabled, right?
Exactly.
Okay. So, and I know you also had a client there where you implemented a particular strategy that was like this. We called the Pizza Man story. Tell us a little bit about your Pizza Man client.
Okay. Well, I call it that because on national webinars that I used to do, I certainly wasn't about to use his name, but it describes a case where a gentleman owned a handful of pizza parlors and he was doing quite well. So his CPA said, let's sock away some more of this money. He'd
Hmm.
already maxed out what he could put into a 401k and was looking for a non qualified plan, which
Hmm.
meant life insurance.
Hmm.
So his agent proposed that he put aside 20,000 a year, and his CPA gave him some pushback on it. So
Hmm.
I was brought in to advise the CPA, and when I taught him all the benefits there are, he turned around and told his client, "Well, don't put in 20,000 a year, put in 40,000 a year." So I guess
Right.
you could say he appreciated the tax benefits.
Right. So you're using life insurance as a savings vehicle. What type of products are you using to do this? How does this actually work?
Okay. You want to use a whole life type policy, but one that's been specially designed in order to minimize the cost related to the insurance.
Hmm.
And there's two ways you do that, but one of them is you only want to carry as much insurance as you need to in order to satisfy the IRS that you're not being abusive. That it's a perfectly legal and legitimate thing to do. You just
Hmm.
put in as much money as they will allow.
I see. And then by doing that, you're accumulating cash in the policy. And then how are you accessing that cash if, for example, you have a disability like you experienced?
And, well, even if you don't have a disability, it's a great way to create a tax free retirement income as well. right? So just so we get both examples, maybe I'll throw that one in. You put in as much money as you can into a policy that is focused on paying out more in dividends and less in guaranteed cash value. The advantage of that is when you get to be retired, you're allowed to pull out the dividends without any taxation whatsoever, without even having to resort to a loan against your guaranteed cash.
Okay, so you can kind of use it as almost like your personal bank to borrow against your own savings, and therefore you're not incurring a lot of the costs that would normally be incurred if you actually borrowed from a bank.
Exactly. And in fact, it's even one step better than that. Picture this: if you own a policy with sufficient capital in it and you become your own banker, when you make a loan to yourself, you repay yourself plus interest. And so I could ask you, where do you think that interest goes? Back to you. Okay. So if I can not only have a tax advantage accumulation plan, but one that throughout my lifetime allows me to accumulate interest and then take it out tax free after I'm retired, I'm a happy camper.
I see. Now, is this only for the high net worth individual, or can anybody in kind of the mass affluent or middle market also participate?
It can be done very modestly. You don't have to have a lot of money. You can start it up as an alternative to whatever other savings plan you were going to use, even if that's only $100 a month.
Okay. So I would say definitely talk to your financial planner about this. Make sure you're working with a life insurance specialist on it. You want to make sure you don't lapse your policies and you're obviously following all the tax rules here. But it's a very interesting concept, and thanks, Paul, for sharing it with us today.
Oh, sure. Glad. Have yourself a good day.
You too.